So it's only early May, and we've already seen a $25 per barrel sell off in WTI futures this year. That's 32%. That's a huge move. Is it too far too fast? Is this market due to bounce back? Let's find out this week in oil. Hey, I'm Aaron Kildow of the Oil Balance, and I'm here to elevate your understanding of the oil market. If you like this sort of stuff and you want to get more information from us, please go to our website, theoilbalance.com. I have several places there where you can send me an email. You can get some more free information. So please go there. If you like this sort of stuff, there's a lot of information I can be sending you. Anyway, let's move on and talk about I have a couple charts for us to talk about for this week's presentation. First of all, let's start out with some price charts just so you can see what I'm talking about here in the open, this massive sell-off. All right, and again, if you go to theoilbalance.com, you put in your email, I can actually send you this presentation if you'd like to have it to look at on your own. So here is a monthly chart of WTI futures. This is the month of April, this huge drop right here. We had a high back in January. We actually got just above $80. In April, we got down to $55.12, I think was the actual number. So just a huge range so far this year. One thing I want to point out, though, is this channel that we seem to be entering back into now and how pivotal it was back before COVID, back before we had the Russia-Ukraine bullishness come into the market. So let's go through that real quick. If you look back here in early 2017, the bottom end of this channel that we seem to be in right now acted as good resistance. It kind of took to the end of the year for the market to really say, hey, we need to be moving higher. Things are getting pretty tight. It took a couple of months for the market to actually push through this range that we're in now. Remember, each of these candles represent a month's worth of trade. Once we got above that, of course, that old resistance line became support, and we were going along pretty well through 2018 until we got to sort of the fall of 18, and then we cratered through it within 1 month. We cratered through that thing, through that band that I think we're settling into right now. And then that became sort of, in the spring, once we got back up into sort of summertime demand, that band that we're in now sort of defined the range for most of 19 and early 20 before the COVID stuff really hit. Of course, with COVID, we got the huge sell-off. WTI futures went negative for one day. That was just a crazy day. Let me know in the comments if you want me to talk more about my experiences that day. I'd be happy to share that with you. But at any point, getting back to the presentation, as demand recovered in 21 from all the COVID shocks and all the lockdowns and all that fun stuff, again, we tried a couple times to break back above the range that we're sort of settling in now in the spring of 21. By the summer, we were able to push through it. But again, you'll notice that we tried testing down to that level again, all the way just before we went into 2022. And of course, then you get into the Russia-Ukraine mess where just that sort of blew everything out of proportion in terms of the price response, the uncertainty in the market, the risk value that had to be put in the market because, we just didn't know what was going to happen. So now we're finally back to testing this range. And again, I've talked about this a lot on this channel, how $60, call it 60 and below, you're really not incentivizing U.S. shale growth. Where we are now, sort of in the mid 50s, the high end of the mid 50s, you're probably incentivizing producers just to kind of sit back and let natural decline rates take over and let that start to sort of guide production lower. We might need a couple more weeks of that before that really kicks in. If we were to get below $50, that's probably when you start talking about people starting to shut in stuff that isn't economical. You're definitely not drilling new holes at that point. So what you're going to see, especially in this presentation today, is that the U.S. producers are basically going off of these different price signals as to what they should do. That's sort of their main thing that they're looking at. If prices are high and their economics work. They're putting holes in the ground and they're bringing oil out. When prices are low, they're doing the best they can to limit production, to shut it in where they can, that sort of thing. And that's totally different than what OPEC is doing, and I'll show you that here in a second. So if we go here to a weekly chart, which is what we normally look at on this channel, again, we see this big sell-off this week. This is all driven by the OPEC announcements. I made a video just about the Saudis and OPEC, and I'll put a link to it here somewhere where you can get to it. But I think it explains a lot about what's going on this week price-wise. If you look at this blue line here, which it's just above the picture, this is pretty close. It's not exactly spot on to the lows from a couple weeks ago, but that's what that line is down here. It's just trying to highlight the low so you can see it a little bit better on these charts. Moving to ethane futures, again, this is a huge link to the rest of the market. NGLs in general, production has been growing. It's been outpacing what OPEC's doing. And again, I have a couple other videos that I can link to show you that information. But just to be kind of concise in this video, NGL demand is where all the demand growth is. Just full stop, globally around the world. If something happens like huge tariffs going on to limit the world's biggest producer of plastics, which is China, from being able to get stuff like ethane and propane that make plastics, then we're going to have a lot of problems in sort of a global macroeconomic situation. So as we mentioned previously, China has removed, they're not going to put retaliatory tariffs on ethane. And so this market seems to be getting sort of back to normal, breathing a little bit of a sigh of relief. Propane futures, sort of a similar thing. We usually get a bit of a big sell-off here towards the end of the month. So I'm not too concerned about this just yet. But again, propane prices and ethane prices seem to be sort of humming along a little bit better than crude and products are. Looking at the margins real quick, so this is somewhat representative of what refiners might see. And again, we're just looking, we want to try to find reasons for the refiners to have to shut down, because that's a huge deal. And we're not seeing it, right? We're just not seeing it yet. Actually, ULSD, which is diesel, ultra low sulfur diesel, margins are actually pretty good on the Gulf Coast versus TI. They're doing okay on the East Coast, New York Harbor versus Brent, the international benchmark, if you will, that trades in London. On the gasoline side of things, yeah, maybe they're getting a little bit dicey. We're kind of on the lower end of the 5-year range, but we would need to go negative, I think, on these to really incentivize refiners to close down. It's just too big it's too big of a deal. It's too big of a thing to try to shut off when 50% of your refinery output is gasoline. You really need a clear signal to shut that down. And then you probably end up shutting down the whole refinery, and that hardly ever happens on most normal refineries. There are a few that seem to operate just as more of a merchant or a trade shop type refinery that are much more sensitive to margins, but we'll get into that a little bit later. Again, looking for signs of issues, especially stemming from the tariffs on China, on Chinese goods. The Port of Long Beach, the Port of LA are the main entryways for Chinese goods to come into the country. And it looks like we're already seeing a bit of a downtick in imports, at least on container ships and that sort of thing. So we should be watching these prices, probably the CARB diesel, that's California Air Resources Board. They've got their own special blend that they have to do in California. But we need to be watching these prices. If they sell off, then that's a really clear sign that things are pretty bad in LA, especially. In that market especially. So I think both of these can be, if you don't get signals from other places, these can be a good warning sign of impending problems coming into, again, kind of relating to the Chinese tariffs and the lack of goods coming in, the lack of work going on. Another thing we should be talking about is the initial jobless claim. So I pulled this off the Fred website, turned it around a little bit into sort of a year-on-year view, if you will. But again, this is the 4-week average, and this is seasonally adjusted. But we got a huge uptick, which is a little bit strange for this time of year. So this, again, we should definitely be keeping an eye on. We've already gotten some warnings, especially from the trucking sector, that some of the trucking firms are starting to lay people off and that sort of thing. So again, some big repercussions could be coming about because of the tariff situation. Hopefully it's short-lived and things get sort of sorted out and people are able to get their jobs back or find new jobs pretty quickly. But again, if you look at gasoline demand, especially from an analyst point of view or an economics point of view, one of the big inputs to trying to forecast gasoline demand is this jobless claims number. So obviously, if people don't have jobs, they're not driving as much. That's what the math seems to sort of prove out anyway. So we need to be keeping a close eye on these jobless numbers too, in terms of what that does, what the knock-on effect then is to gasoline demand and diesel demand. So just to get to some headlines real quick, of course, we're still dealing. There seems to be lots of OPEC surprises. It's like the gift that keeps on giving. Saudis say they can live with lower prices for longer. I think that's what moved the market lower this week. And again, that's what the subject of the video I put out earlier this week was all about. Maybe the plot twist, if you will, coming out of all this stuff is it looks like OPEC production and exports actually fell in April versus March. That's crazy, right? So we're looking at OPEC exports down 1 million barrels per day, month on month again. So April versus March, and then production down 500,000 barrels per day. So again, plot twist. We thought their production exports would be coming up. The actual numbers seems like they were going the other direction. They were taking them down. So if you remember, the Saudis specifically were talking about other people cheating. So maybe some of that is trying to rein in the cheating, the overproduction a little bit. And so the net result was to really bring production. And I think there might also be some maintenance issues going on as well that's impacting those numbers too. There are members lobbying for an increase in production for the month of June already. So again, we'll have to see how that goes. On the 5th of May, we should get news from the latest OPEC conference. It's a virtual call that they're going to do for OPEC Plus. And that should happen on May 5th. So we need to make sure to be paying attention to that for any new information. On the tariff front, it seems like there are some deals getting done. As we mentioned, China is not going to put tariffs on ethane and other items. Ethane is especially important to the oil markets. So that's why I listed that out by itself. Some trade deals are getting done. I guess I repeated myself there. When we can see sort of the impact too on the PMI number. So the official Chinese PMI number slipped to 49. The Caxton PMI number came in at 50.4. So again, below 50, it's contracting. Above 50, things are expanding. So you would want your PMI numbers to be above 50. So a little bit of a mixed bag. Both of them, though, are down month on month, I guess is the big point. On the Russia-Ukraine peace deal, as you've probably seen in the headlines, the U.S. and Ukraine signed a minerals agreement just this week, and now the U.S. is no longer a mediator in the peace talks between Russia and Ukraine. I'm not sure if those two things are a result of each other, but the point is that we do have a mineral agreement now with Ukraine. I think it needs to be ratified by their Congress, and the U.S. has sort of stepped back from trying to negotiate a peace between the two. And for what it's worth, Russian oil exports are trending higher. I could have put that with the OPEC surprise numbers as well, but I think it sort of makes sense as prices go lower. Maybe they need to put more oil out there to try to keep the revenue number the same. So again, there were some issues on the CPC pipeline, for instance, that may have caused their previous month's exports to be low, and now we're just seeing them bounce back to where they should have been the whole time. On the Iranian front, you probably saw the Bandar Abbas explosion, the port explosion. From what I can tell, I don't think any energy infrastructure was necessarily impacted by that explosion. However, they did shut down the port. Weekly loadings are down about 50%, again, versus sources I'm looking at. So I'll be watching those closely to see if they bounce back or if there's some other sort of lasting impact that we need to dig into and figure out what it is. And then on the in the London North Sea market, the BFOET, so it's the Brent 40s, Oseberg, Ekofisk, and Troll loadings are going to be the lowest since June. It looks like the Ekofisk field has some planned maintenance coming up, and that's going to take a lot of barrels offline. So if I remember right, last month we did almost 600,000 barrels per day in loadings, and or in, I should say, in May, that's what the schedule is. For June, that drops to only 350 with Ekofisk taken back out of there. And then we saw news as well that the SPR is damaged. Of course, the Energy Secretary says he's going to keep buying oil to restock the SPR. And again, just sort of stepping back from the partisan politics really quick, the previous administration had been slowly filling up the SPR. It looks like the Trump administration might try to step that up, but 2 of the 4 main salt dome mines seem to have some sort of damage to them that the Energy Secretary was referencing on a interview that he gave earlier this week. So that's a big deal, because what I think a backstop in my mind anyway, and I think in a lot of other people's mind, is if the WTI market got too soft, the DOE, the President Trump could just come in and tell the DOE to start buying back more oil to refill the SPR. And that would be like a shock absorber to take barrels out of the commercially available market and put it into the sort of government managed inventory, if you will. Directionally, I think that's the right thing to do just for national security purposes. And again, if prices get too low, that's a good way to keep our producers from getting too impacted. I mean, we're down $25, so the producers are impacted, right, already. But to be able to absorb some of that price shock and take barrels off the market, if you will, and put them in the SPR would definitely help. If that's significantly slowed down because there's damage in some of these salt caverns, then again, that's kind of a big deal. All right, so I was watching some other YouTube channels I want to call out. It's what's going on with shipping. Mr. or Dr. I should say, Sal Mercogliano had some really good stuff on his channel here lately about the activity in the ports, and he showed us a couple places to look. One is the bts.gov, and the other is the Port of Los Angeles has this port optimizer function that you can get into, and it's free. Maybe I wasn't used to that website, so it took me a little while of poking around, but I think there's some really good information on there. And that's what this port optimizer is, this top piece here, showing sort of the downtrend in vessel traffic coming into the Port of LA. So again, down this week here, April 27th to May 3rd, down 27%. But as we travel into May for next week, it looks like it's going to be reduced even further. And then what's on the schedule, and this becomes more sort of tenuous because it's further out in history, so subject to change, it looks like things are starting to bounce back into week 20, which is starts on May 11th. So maybe there's some hope on that front. And then from the BTS, I was able to see an increasing capacity of container ships calling on U.S. ports. So directionally, that's probably a good idea. Dr. Mercogliano was talking about some front loading, a bunch of container ships coming in, trying to beat the tariffs. And I guess people in the know in manufacturing were trying to get a bunch of stuff to come over anyway. So a couple interesting points from that we should be keeping an eye on, again, because of the economic impact and how it just turns around and pertains to diesel demand, especially as we try to move things coming in from the ports to the rest of the country where they can be consumed. So I thought this was an interesting chart. I threw this together. My father was actually asking about this. Hey, Dad. So this chart's in here for you. Um, but again, like I was saying, the U.S. is simply looking at price inputs as to how much crude oil to produce. Right. That's the big thing. So you can see as prices were going up, so was production. We had 2020 happen, and then prices slowly climbing back. And then here, the last couple of years, we've been hitting, pretty consistently $70 type range and crude oil production from the US. And this is just the crude oil production number. We're not counting in other stuff blended, NGLs blended in, or adjustments numbers. We're just looking at the monthly production, kind of hanging out just north of 13 million barrels per day, 13.5 in that sort of range. Meanwhile, the Saudis, who are the main, they're the ones that really drive the OPEC meetings. They're the ones that have the biggest production within OPEC itself. Their production is pretty similar to what Russia's doing. If you want to look at the bigger sort of OPEC plus sort of numbers, but you can see how they were really taking production down. They're taking production off the market. So if you look at this time period, say 2016 to 2019, we're looking at an average of 10.1 million barrels per day during this time frame. If you skip sort of all the COVID stuff and we just move ahead to 24, 25, so now the average production number is down to 8.9. So definitely you can see the big change, hopefully, these last several months versus pre-COVID type numbers. Saudi has really taken a lot of barrels off the market. A lot of people think they should be able to get back to 11 million barrels per day. There's a few people who think that they could actually continue to keep going at 12 million barrels per day. We've seen them spike up there once or twice before COVID. Can they actually stay at that sort of level? We'll see. But again, this is the main threat. So there's 1 million barrels that Saudi should be pretty easy to, from a mechanic standpoint, to bring back to market. And that's what has the market so worried that they would actually start to do that. If you bring that back to market just because you could mechanically, that doesn't mean there's the demand to soak that up. And that would, without bring back supply, without demand, you're just going to create too much inventory in the market and crush prices. I mean, that's just basic economics right there. So again, in the piece that I did on Saudi Arabia earlier this week, that I'll put it in the description, and I'll have some links to it here as well. You can really see the fear in the market about what's going on. So if you sort of keep that in mind through the rest of this presentation, I think you can start to see where my questioning is coming in from the very beginning. Have we moved too far too fast in terms of price? Yes, there are things to worry about. Have we overdone it? I guess is what I'm getting to. So what I want to point out is gasoline inventories are now below year-ago type levels. We're not too far off the bottom of the 5-year range. I think they're going to bounce back. We'll see. Again, I'm still thinking that there'll be some sort of demand hit here in the next month or so, just because of the tariff situation about stuff not coming in from California, from the ports of California. And that's why we went through all that previously in the presentation here. Distillate inventories, diesel stocks are at the bottom of the 5-year range. Propane stocks are not picking up like they did last year. We're still sort of in the middle of the range. But again, as demand increases, it looks like propane is falling behind a little bit in terms of inventory. Residual fuel is still quite low. And then crude oil, again, we've been at lower rates, but I'm not, if you said, hey, crude oil prices are at, $59, $58 per barrel, where do you think inventories are? I probably would have told you north of 450, maybe 475, maybe 500 million barrels in the U.S. So again, it seems like the market is pricing all this concern about OPEC and what they're going to bring back to market, and we're not pricing in the actual inventories that we're sitting at. And it's not just that inventories are low, it's actually that demand's been pretty decent. So we did see a bit of a demand hit on diesel this week. And again, that could be the first impacts of ships not coming in from China on lower demand from California. They don't break it down on the weeklies in terms of where in the country the demand looks soft. It just gives you one number on the weekly numbers for demand. Gasoline demands looked really good these last couple of weeks and starting to turn back up higher on a 4-week average, which I'm not showing here. Jet demand's been very good up until this past week. So again, if you just look at these demand numbers and you say, WTI is at $58, that probably wouldn't make sense to you, just looking at those two things in isolation. Retail prices, I flip back to this older mode that I had where I've got the 2019 prices in there, and you can see at this point, we're actually closer to 2019 prices than to year ago prices for retail. And again, this is a national average. So maybe even a little bit better where you are. I think it's a little bit better than this in Texas where I am right now. But again, just wanted to kind of point this out that we are seeing, at least from a consumer standpoint, we are seeing the fruits of this sell-off, especially if you look at the price path in 2019 during this sort of April into May time period and the price path last year into that same time period. We should be increasing in price. The gasoline's getting harder to make because we're going into summer grade. But we didn't get that this year, or we got just a little blip of it, and then we've been coming off since then. So the week-on-week moves have not been that big. I mean, I was expecting maybe something a little bit bigger on the week-on-week sell-offs, but maybe the better point is when you start looking at it year on year, when a year ago we were sort of steadily increasing week-on-week, things are getting better for the consumer anyway. And like we saw earlier, they're not that bad for the refiners just yet. So we might be able to sort of thread the needle to where you get a good price for consumers and a good price for refiners because crude's relatively cheap and sort of go from there. So again, it's been a super interesting week. If you like this stuff, if this is interesting to you, please go to theoilbalance.com. We've got more information for you there. There's at least one button you can hit that says sign me up for free information, and that sends me an email and I'll get that right out to you. But it's going to be an exciting market. What do you think? Do you think we've come off too far, too fast? Is the market set for a bit of a bounce? Maybe we'll find out on May the 5th with the most recent OPEC Plus meeting. So stay tuned. It's going to be an interesting one. Thank you, and see you next time.